Good afternoon, everyone. We're going to spend the next 40 minutes or so talking about the market and option indicators. It's a pretty interesting market right now. Most of the time, it's an interesting market. Um, just a quick background on our company. I started as a derivatives research firm about 30 years ago. Then we moved into money management after the crash of of 02. I'm sorry, '08. After we had some pretty good strategies there. And we also do a certain amount of option education. Our managed accounts are positive on the year, and we have been positive all the way through. We had a great March, and our newsletter recommendations are having their best year ever. In that vein, whatever, if you go to this website, optionstrategist.com/festival, we are offering a discount. I'll come back to that later, but also we will be sending you the PDF of this webinar. So let's look at the four main indicators here that I follow. The first and foremost is the chart of the S&P 500 itself, because price is the most important thing. But then we look at equity-only put-call ratios. We look at breadth. We have a kind of a new thing going on there. And then we look at VIX and other things having to do with volatility. I have an important rule and a corollary, and the important rule is oversold does not mean buy. Right now, nothing is oversold, but that was certainly the case during February and March. Market got oversold and just kept going down. So you have to wait for confirmed signals, even though the market's oversold. This is a little more apropos, but it's the opposite. Overbought does not mean sell. Now, we do have some very overbought conditions right now, but they're not confirming with sell signals, and so you can stay long all during that time. So here's a 2-year chart of the S&P 500 just to set some sights on a couple of things we're looking at. First of all, the ultimate goal here for the bulls is to break out to new highs over 33.90, so that will be a resistance area. Then when we broke down in February, we had this huge gap here, this circle right there. So the top of that gap at about 33.30 is also resistance. Just recently, and this was yesterday's action, it's a little hard to see that we gapped out there to yet another new high. And so that leaves, that took care of that breakout. There's a little support here at 3,200, a little bit better support here at 31.30. And then major support down here at 29.70. In my opinion, if we were to break this 31.30 level, that would change this chart to a negative. Otherwise, it's a positive chart. And there aren't a whole lot of things more that you need to know about it. But this has been a monster decline and then a monster rally back, taking out 3 years of profits and then restoring them all within the first within 6 months of the breakdown in February. Just to show you that there can be these long rallies in bear markets. This is what happened in 1929, 1930. I'm not going to say it's happening again, but just it never hurts to know the past. When the market crashed in 29, made a little bit lower low in November, and then rallied all the way into April, rallied 48%. Volatility fell to extremely low levels. Some bellwether stocks like AT&T were making new all-time highs, and yet all of that didn't prevent the rest of the bear market from occurring. So don't get complacent is my point here. So just to sum this up, right now the market has broken out with a 2-day close above what had been resistance at 32.80. So we're above that. So now we're setting our targets on 33.30, the top of that gap, and then 33.95, the all-time highs. Below here, there's the support at 3,200, 31.55, and then the more important support, in my opinion, at 31.30. So the SPX chart is bullish, and it's going to stay that way as long as it's above 31.30. So there are a lot of other things can be going on. You can get buy signals from some things, sell signals from others, but as long as the S&P chart is bullish, you need to have a core bullish position. So we do also take a look at Bollinger Bands, but ours are modified. When John Bollinger invented the Bollinger Bands, he defined volatility as the standard deviation of daily closing prices, which sounds reasonable, but that's not what the math guys do. Math guys in our field, in the option field, are Black-Scholes. And so Black-Scholes define volatility as a percentage of standard deviation of daily percentage price change. It was a slightly different number. So we calculate Bollinger Bands using that definition of volatility, and we get signals outside the plus and minus and plus 4 standard deviation bands. We've had some really nice gains with this system over the years, but sometimes the signals get stopped out too. So it has been on a sell signal since June 11th. I'll just show you here. This is the chart with the bands drawn on it. So for example, right here, this would be the plus 4 sigma band, and this would be the plus 3 sigma band. So you see right here, the bands are wiggling around. Okay, and we moved outside here on that, what actually turned out to be an island reversal. It broke back inside the band, and that was the sell signal. Since then, we would get stopped out if it rose above the 4 sigma band, which is right here, or we would take our profits if it fell to the minus 4 sigma band, which is here. You can see it has done neither. So this signal is still in effect. It's a little bit reminiscent of what happened here, the sell signal in January. The market came down a little bit, then went to new highs. So that sell signal wasn't looking so good, but then you can see it did not get stopped out, did not go above the plus 4 sigma band, and eventually the market broke. So right now that signal is still in effect. We are carrying a small bearish position along with our core bullish position because of that. So the next thing we look at is put-call ratios, and we use the equity-only put-call ratios to predict the broad stock market. Equity-only meaning all stock options that trade. So there's millions of them that trade every day. And the theory of put-call ratios is a contract theory. It was invented by Marty Zweig back in the 1950s. And basically, it's just this: if too many people are buying puts, then we want to be thinking about doing something bullish on the market because they're all bearish. Conversely, if too many people are buying calls, they're all bullish, we want to do something bearish. So we'll try to define what too much means. But simplistically, let's just say we have IBM. At the end of the day, we sum up the volume of all the puts traded in IBM. Separately, we sum up the volume of all the calls traded, divide the two, and that's the put-call ratio. So since puts are in the numerator of the fraction, heavy put buying makes the ratio go higher. But when would you actually get heavy put buying? Well, typically that would be when the stock is going lower. So the ratio moves in the opposite direction from the stock price. Same thing here. Since call buying is in the denominator of the fraction, heavy call buying would make the ratio fall. But when would you get heavy call buying? Well, that's typically when the stock is rising. We keep a moving average. I use 21 days just in case there's anything to Fibonacci. And this is the ideal situation. The stock price and the put-call ratio move inversely to each other. And local minimums on the put-call ratio, like here, local minimum, that's a sell signal for the stock. And a local maximum on the put-call ratio is a buy signal for the stock. So if all things are working well and we have this nice inverse relationship, that should hold. This is not a current chart, but it's the S&P 500 on top and the equity-only put-call ratio on the bottom. And you can see that the inverse symmetry holds most of the time. And that's why we use the equity-only put-call ratio to predict the broad stock market. So here's the current chart. This is the standard ratio, which is using volume of options only. So for example, on the left-hand side of this chart, 100 means 100 puts are trading for every 100 calls. In stock options, you can see that rarely happens. And in fact, the ratio here in February or March got up to the highest level in history. Our history goes back to 1993 with this data. And that was the highest it had ever been. There was this little wiggle here, but we have a computer analysis program that looks forward like a chess tree program. And it said, don't worry, that's going to continue to go down, and it did. So that buy signal is technically still in effect. There was a little bit of a slight upward lift here for a little while, and then back down again. So now we're bumping along here at very low levels. The lowest, I'm sorry, that says 2014. I should say 2004. The lowest level since 2004. It's crazy to think that there's that much call buying going on. But as I said before, overbought does not mean sell. This is certainly overbought. We have seen more call volume in many different facets than we've seen in a long, long time. In fact, recently one day it was the most calls ever traded on the CBOE, equity only calls, stock option calls. We also follow the total put call ratio. So it's also at its lowest. Total includes index and stock options. That's at its lowest level since 2004. The equity only put call ratio on the CBOE, which only encompasses options that trade on the CBOE, is at its lowest level going as far back as our history goes, 2001. Now, I've drawn a chart here. I have these long-term charts, hardly ever get to use them, so I thought I'd throw them in here. So there's three put call ratio charts on this page. The total ratio is at the top, the standard ratio, just using volume of equity options, is in the middle, and then the CBOE is on the bottom. And you can see the circles over to the right-hand side. That's where we currently are. And then the horizontal lines going left shows you that we have not been this low since this 2003 on both the standard and the total ratio, and in fact in the CBOE going back to 2001. And note that both the standard and total ratio data goes back to 1997. So that's a long time that we haven't seen this much call buying. And it's even more call buying than you might think, because in general, over time, the put call ratio tends to rise slightly as more and more institutions favor put buying as protection. Now, with the advent of computers, we were able to calculate the weighted put call ratio, so we can bring in a little bit more data, and we can calculate the dollars being spent on puts versus the dollars being spent on calls. So what we do at the end of the day, we take the options price and multiply it by the volume that traded that day to compute the dollar volume. You could do that trade by trade, but that's a very expensive data set to acquire, and it wasn't giving us any, we tried it for a while, wasn't giving us any better data than just doing it this way. So at the end of the day, we make that calculation for, let's say, all the options in IBM. We sum up those dollar volume figures for all the puts, sum them up for all the calls, divide the two, and that's the weighted put call ratio. And now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. In general, especially with individual stocks and futures, the weighted ratio is definitely better. In the broad sense of things, you get about the same signals. They're just a little more violent. So here, for example, in March of this year, we got up near 200, meaning that $200 were being spent on puts versus 100 for every $100 being spent on calls across the entire spectrum of stock options. That's a huge number. So that, again, local maximum on the put call ratio chart gave us a buy signal. The little wiggle was not a problem. And now we still have not reached a minimum here. We're still looking for some sort of local minimum before this thing rises. So back here in January, it dropped to the lowest level seen since 2018. We haven't gotten that low again here yet. The reason the first one is so low and this one is not is because it's volume versus dollar. As you may have read, there's a lot of small retail players in the market right now, and they're buying volumes of calls, but they're not spending as many dollars, let's say, as maybe the institutions were back here in January. In any case, again, overbought, but still on a buy signal. So just to summarize, we're still on these buy signals that came from the March lows on S&P and the March highs in the put call ratio. The previous sell signals were excellent, so I expect the next ones will be as well. Just haven't gotten there yet. We're waiting for a reversal upwards, and again, overbought does not mean sell. I want to just speak for a minute about what we actually buy here. Since we're trying to predict the underlying, we're going to try to buy an option that's going to reflect what's going on in the underlying. Now, the delta of an option reflects how much of the price change of the underlying the option captures. The highest the delta of a call option can be is 1. Well, you can't really buy too many call options with a delta of 1. They'd be so far in the money they wouldn't be cost effective. But we can buy, let's say, something with a delta of 0.7. So that's a slightly in the money option. So if we were getting these signals on SPY, on S&P, we trade SPY options slightly in the money. If we're looking at a longer term signal, maybe like a put call ratio signal, we might buy at the money. Again, still a fairly high delta, 0.55. So we're getting some bang for our buck. If we're right about predicting the underlying, our options is going to make money. I see so many option traders that buy deeply out of the money calls that end up being right on the underlying and wrong on the option, and that's not what we want to accomplish. Do we ever do spreads? On TV, all they do is spreads in options, vertical spreads. That's ridiculous. No one really trades that way. And you'll hear people say, well, it's less risk. It's still 100% risk. A bull spread or a long call, both 100% risk. If you're worried about the dollar risk, then buy a few less calls and just spend the same dollars without cutting off your profit potential. Because if the options are cheap or average price, you don't really want to spread. The only time you might want to spread is when the options are expensive. That certainly happened during this bearish market back in February and March, but even there, it blew right through everything on the downside. So spreading there was not optimal either. So if you are going to spread, only do it when the options are expensive. And they're still pretty expensive right now. VIX is still around 24. So if you're going to use a call spread on SPY, I would use the strikes, if you're going to spread it, I'd have the strikes 12 to 15 points apart, and put spread even farther apart, 15 to 20. And then what we do in these situations, if the underlying gets to your short strike, don't just sit there and say, all right, well, I can't make any more on this spread. Roll your spread up or down if it's put spread, and when the short strike is hit. So we do this to a certain extent in our recommendations, but again, we are only using bull spreads and bear spreads where the options are expensive. If they're average price, we don't do that. Here's some individual put call ratio charts. On these, we have a little bit of a different interpretation. Still, local maximum is a buy signal, and a local minimum on the put call ratio chart is a sell signal, but we only do it at the extremes. So for example, on this chart, it starts out with a buy signal right here. Right there's the put call ratio. If we look back, you can't see it on this chart, but for the previous 600 days, this put call ratio reading would have to be in the 90th percentile or higher. So it was. That was a pretty good buy signal. Then we came along, we got one here, one here, one here, 3 sell signals. The blue letters mean not too successful. And so finally we got all the way down here in February. And why would we take that sell signal when none of these were working? Because it was down at 20. In other words, 20, this is dollar weighted put call ratio. So only $20 was being spent on puts for every $100 being spent on calls. That just seemed ridiculous. And so we set a conditional level right here. There had been a little support at 182. We said if it broke there, we'd buy puts. We did. It came down and actually ended up giving a nice buy signal here. But by the time our computer analysis program confirmed it, the thing had already up to here, and I figured I'd missed the bottom. Obviously, we could have still bought it there, but we did not act on that one on the way back up for the stock. But these are more recent. Right now, we have an open one on Micron Tech. You can see the local minimums down here at the bottom of the chart. So those are the sell signals. But again, since there's this sort of support level here of 48, we're saying we're not going to take a position unless the stock breaks 48. Then we'll buy the puts. If it doesn't, then we don't lose any money. We're not buying the puts. Boeing, we just took a new position in Boeing here. I thought this was kind of interesting. You can see that the put call ratio got down again to a very, very low level. It was in about the 5th percentile of all previous put call ratio readings there. And yet the stock really hadn't rallied that much. I mean, it's just that, the publicity machine, the sort of retail attitude about thinking Boeing is going to recover. And you can see the chart is already breaking down. So we didn't really wait for a breakdown. Once it broke this level here and we got this most recent local minimum, we did buy a bear spread, their put bear spread. Here's another one we're watching, Oracle. The put-call ratio got down to one of its lowest readings ever and then turned back up. So local minimum, that's a sell signal. But here there was support at 55. So we're waiting to see if it breaks 55. We would take a bearish position then, but if it doesn't, we won't. Futures, it works with futures too. So these put-call ratio charts here are using the futures option volume data. Now we can trade ETFs on some of these. So this is cotton for CT is cotton. And you can see we had a nice buy signal there. We had a nice buy signal back there a ways. And then this one, so we're waiting for a breakout there. We got it. And we bought BAL options. With BAL is the ETF for cotton futures. So you don't have to have a futures account to trade this. This one's getting a little long in the tooth, but it's still on a buy signal. Here's a more recent one, coffee. Again, we got a buy signal here. Previous ones had been pretty good. And we waited for this breakout. We got the breakout immediately. It came back down below, but now it has taken off to the upside. So again, we're trading these with the ETF JO. And finally, a more recent one here in cocoa, same sort of thing, buy signal, and we're trading with the ETF NIB. So we make these put-call recommendations in our newsletters, both the daily strategist and the option strategist, quite frequently. The third thing we look at is market breadth. So in this case, breadth is just simply advances minus declines. We can keep a cumulative total, and we can also keep an oscillator. The oscillator is defined as being 90% of yesterday's oscillator value plus 10% of today's advances minus declines. So we keep this with stocks only data, which I think is a little better than New York Stock Exchange breadth data. And what stocks only are we talking about when we're talking about all optionable stocks? So on the pink line there, that's the S&P 500. Below is the oscillator. And when it gets above plus 200, that's a overbought condition. And when it gets below minus 400, that's an oversold condition. So you can see, well, first of all, here in December of 2018, right before Christmas, we had the most oversold reading in history. This year in March, we just exceeded that by a little bit. So both very, very oversold, but you're not, oversold does not mean buy. We don't actually buy till it stops being oversold. So there's where we bought, which was not long after the bottom. And ride it up. Now we've been up in this area, getting overbought, falling back out of it. Most recently, we were overbought and fell back out. So that's a sell signal. And so the short-term breadth here has not participated along with the broad market. As we said, the broad market is making new relative highs, trying to shoot for the all-time highs, and yet breadth has been kind of weak. Sort of in a bad way, that's the same thing that happened in February of this year. The market was making new all-time highs, and these breadth oscillators were not keeping pace. So while it might not mean anything for the minute, it's still something, sort of a negative thing to keep in the back of your mind. And if S&P breaks support, of course, that would be a confirmation of that. Anyway, right now, these breadth oscillators have been flipping back and forth. And we have split signals amongst them right now, them being New York Stock Exchange and stocks only. As I said, the breadth is not expanding. We also keep the cumulative advanced decline line, and that has been doing better. I'll come back to that in a minute, but we have, I just wrote an article on this last week, an in-depth look at cumulative advanced decline lines, and they have moved to new all-time highs. And usually if they go first, the S&P will follow. Now, the last area I want to look at is volatility. We look at several things having to do with volatility, and we look at most of them through the eyes of VIX or the VIX derivative products. So the trend of VIX is important. We should be trending opposite to the market direction, but also on this VIX chart, spike peaks are buy signals. So sometimes VIX gets very low. It's not the case right now, but it was the beginning of this year. And sometimes traders will say, well, VIX is low, I'm going to start shorting the market. Again, that's an overbought condition. That's not a sell signal. It's overbought, yes, if VIX is low, but it's not bearish until VIX begins to rise. So here's the current chart of VIX going back about a year, and just in line with that last statement I just made there. Here you can see VIX was very low in the last part of last year and the early part of this year, but it wasn't really bearish until this happened right here. And this is the 200-day moving average of VIX, and this is the 20-day. Both VIX and the 200-day crossed up, and the 20-day, I'm sorry, crossed above the 200-day. That's a major sell signal for the stock market. It happened before the breakdown. That actually happened on February 21st. And that's been in place all the way until 2 days ago. And now for the first time since then, the 20-day moving average is below the 200-day and VIX is below the 200-day. So that's a major buy signal. And there's been a number of these over the years. There was one on this chart back in October of last year. The market rallied pretty strongly for 3 months after that. There was one in February of 2019, and there was a major one in March of 2009. So you may say, well, the market already has rallied a lot, but I'm just saying that the trend of VIX is now officially lower when that happens. And so the trend of the stock market should continue to be higher as long as we're in that case. I just quickly put together that 2-year chart again, and I marked on here where those crossovers took place in VIX. So you can see there was a buy signal back in the middle of 2018, gave us a sell signal in October of 2018, which was a really good one. And then similar to now, the market rallied back a long ways before VIX was able to come down and cross over and give another buy signal. So, that buy signal is kind of late in the game. It's kind of like the one is now, but it still lasted for another couple of months. Then there was that buy signal in the fall of 2019 that I mentioned before. And then, of course, the major sell signal early this year, and now the new buy signal. So we are acting on it. I mean, obviously, there are other indicators that we had which are giving us buy signals much closer to the bottom. But, when VIX is 90 and the 200-day moving average is at 24, it's going to take a long time for them to converge. But they finally have converged. So overall, the VIX chart is bullish both in the short term and the intermediate term. I'm just going to back up for a second here. All those B's on there are VIX spike peak buy signals. We have a system we use to trade them with. The red ones are successful. Blue ones were stopped out for a loss. So you can see we've had a series of successful ones now. We're still operating on the most recent one, which was on July 14th, I believe, is where that one came. The very last one here was on July 14th. That's still in effect. All right. So there's another thing we look at with VIX, and that's the actual products that trade on VIX, the futures, and sometimes the futures options, but mostly the futures. So the futures and VIX are not exactly at the same price. The futures trade above or below the price of VIX. If they're above the price of VIX, we say they're trading at a premium. If they're below the price of VIX, we say they're trading at a discount. So the term structure is how the various futures line up with each other. So for example, last fall 2018, VIX was low and the front month future was here and then here and next one on out. And so the term structure slopes upwards and they're all above the price of VIX. When that happens, that's bullish. And that's what happens most of the time. But occasionally it flips and you get VIX being the highest and then the futures are below it like that. That's what happened in late February and continued on through March. That's bearish. So we pay attention to this because it is a market indicator. So right now, this construct is mostly bullish. I'll show you. Here's the current prices as of last night. They didn't change that much today. Here's your various futures contracts. VIX closed at 24. Now, the August futures are at 25.85. So if we subtract off the price of VIX, we get the premium plus $1.57. So you can see these are all plus numbers. So they're all trading higher than the price of VIX. But there's a bubble in the term structure, sort of. In other words, October is really, really high compared to everything else. It kind of slopes up to October and it slopes back down after that, or down to flat after that. What's going on in October? Well, the way these things work, they use the options that expire 30 days ahead of the futures expiration date. So this October futures are based on SPX options. that are expiring in the third Friday of November, which I forget what that is. I think it's the 16th or something like that. In other words, after the election. So options just after the election are quite expensive because people expect the election to be volatile, and therefore that's dragging up the price of the futures. And once this one gets dragged up in the middle, it drags these sort of with it. So this is a huge premium for a 3-month future, and that's going to go away by expiration. And we have in our newsletters tried to take some strategies to take advantage of that. I'm not going to go into that completely now. But you might say to yourself, well, where am I find the price of VIX futures? They're on the CBOE.com website, right on the front page, on the upper right-hand corner. So just go to www.cboe.com, and in the upper right-hand corner, you'll see the price of the futures. It might be delayed a little bit, but you can certainly see them vis-a-vis the price of VIX and whether they're trading, whether the term structure slopes up or down. Now, the CBOE does publish 5 volatility indices. VIX is not the only one. VIX is a 30-day index. They also publish a 9-day, a 3-month, a 6-month, and a 1-year. And here, again, you can look at their prices as a sort of a term structure. Here, the term structure is sloping upwards. And the last one, the 1 year, has been having trouble staying above the others. Let's see, I think it was slightly above there, but today it's back below again. So it kind of slopes up through here and then down after that. Why it continues on higher for 6 months here than rather than just 3 months, like the futures are showing us, I'm not quite sure. But this is a CBOE publication, and I say it's like the poor man's term structure. If you don't want to look at the futures, you can just look at this and sort of get the similar data. So these term structures, I'm considering them modestly bullish. In other words, the big futures are trading at a premium. They have the term structure slopes upwards until October, then downwards after that. The CBOE indices, the last chart we looked at, that mostly sloping upwards. So I'm going to say it's mildly bullish. It's not roaring bullish, but it's mildly bullish. So if we put all this together, what do we have? Well, the SPX chart is bullish, and that's the most important thing. There is that modified Bollinger Band sell signal. It's the only sell signal we actually have right now amongst our major indicators. The put-call ratios are overbought, but remain on buy signals. The breadth oscillators were mixed, so that one was a sell signal, but these have been very short-term and flighty, but wiggling back and forth. So I would say the biggest thing about breadth is these oscillators are not confirming the new breakout. But again, the breakout's intact. You would have to see S&P fall back before you would actually be worried about the breakout failing. VIX, the trend is bullish, and a spike peak buy signal still in effect, and that's extremely important. The volatility term structure is mildly bullish. So overall, this is bullish. So we are bullish. We have several bullish positions in place, some based on that volatility crossover, some based on the chart of VIX moving above resistance levels. And we're going to stay bullish until support is broken, which would be right now 31.30. Now, I wanted to mention a couple other things before we wind up. I had mentioned historic volatility and what it's done. This is a chart of the historic volatility of the Dow going back to 1928. Now, we didn't have SP then, S&P then, but the Dow was just as good. So this volatility got up to this level shown across here. That's 116%. I mean, that is really volatile. But you can see it was matched in the crash of 87 and then matched again this year. I think this year got to 106%. Just insane numbers. But I mentioned that rally that took place in 1929 to 1930. The historic volatility dropped all the way to 8% while that happened. So right now, historic volatility is down from this 106. It's now down to 13. That's not on this chart, but just take my word for it. Right now, the 20-day historical volatility of S&P 500 is down to 13. If it falls below 10, I start to get worried. If it falls below 8, I get really worried. And you can see it's hard, a little bit hard to see it, but it did fall below 8 this year, and we got a sell signal from this indicator in January of this year. And again, it didn't take place right away, but it eventually did kick in. So we are looking once again at this indicator. If it falls to 8, you can see 8 is, it's a little hard to see where the scale is, but 8 is about right here. So if it falls below 8, and it certainly could be possible if we go to new highs and then plunge forward from there, this thing could fall back below 8. And while I wouldn't necessarily expect a 90% bear market like we had in 1930, that still would not be a good thing. This is just to show you, if we include VIX, on top of that chart, we only have VIX going back to 1986. That's the orange line. You can see that VIX, for the most part, is higher than historical volatility. And that's why options, S&P options, are pretty much expensive, and why many strategies are built around selling them, because they are a good sale most of the time, just not all the time. So you have to watch for that trend of VIX to change, and then maybe the term structure change. You get out of the way when that happens. Finally, I mentioned that we had just put out a new paper on cumulative breadth. We also looked at cumulative volume breadth. And we look at the volume on advancing issues minus the volume on declining issues, keep a cumulative chart, or keep that track of that cumulative day to day. And this is the way the chart looks. The bottom pink one here, pink line, is the S&P 500. So you can see that we're not at a new all-time high yet. Yet the cumulative volume breadth is at a new all-time high. And these green arrows here indicate previous times, and mostly they were short-term things, where this indicator went to a new high in advance of the S&P 500, and every time it followed it. Now, since 2000, we've only had 10 occurrences, but all 10 times it's worked. So now we're on the 11th one. Will it work? I don't know. But I think it will. And so this paper is part of what you could access if you go to our website, optionstrategist.com/festival, and sign up for either the daily volume alerts or the daily strategist. Daily volume alerts, we have all the indicators I talk about here, plus we look for ARB situations too. So we've been pretty successful with those. This offer will expire on August 11th. Our track record is available up there. This is the Daily Strategist, same sort of thing. The Daily Strategist, by the way, includes the Option Strategist. This is our most popular newsletter. It comes out twice a day. There's just a lot of data and a lot of recommendations, but not a crazy number where you can't keep track of them. So we're very active with the trading, but I wouldn't say we're day trading or anything like that. Also, we will be sending you the PDF of this webinar. We do have a once a month, a Saturday morning session where I get together with whoever wants to pay to be there, and we talk about the market, we talk about any questions on options, and then I'll usually deliver a webinar. Let's see, the next one coming up, I believe that topic in the next one is going to be option modeling and the Greeks, Black-Scholes model, that sort of thing. We also have a YouTube channel. I update YouTube short video every Monday morning before the market opens. So I invite you to visit optionstrategist.com/festival, and that's my contact info if you want to try to get a hold of me. And I think we're right on time.